All right. Well, Wells Fargo sees little progress on inflation ahead. Mike Schumacher is the firm's head of macro strategy. He joins us here at the NASDAQ. Michael, welcome.
Great to be here. Thanks, Melissa.
I thought it was a perfect time to bring you into this conversation because you actually think that we've seen peak rates pretty much, and we may have seen it last week. We did see the big surge, though, today, and I'm wondering if you sort of rethink that narrative.
No, not really. I mean, it's one day, big deal, frankly. And if you think about it, I believe the big move today was predicated by Treasury supply. We had the announcement last week. It was high. Everyone knows that. 10-year auction yesterday, pretty big, went okay. 30-year auction, big again, didn't go so well. But the thing about Treasury supply is it's very predictable. The next news out of the Treasury is not until November 1st with the next announcement. Yes, there will be auctions, but I think the market can deal with that. So I wouldn't call today a one-off, but today was really the combination of a few things coming together. So to me, it's normal volatility. Yes, rate volatility is high, but today is not crazy in that context.
So when you say we've seen peak rates, but they stay close to peak? Or we've seen peak rates and they start coming down?
We think longer-term rates actually come down a fair bit. And it's really interesting. If you think about and look at historical Fed cycles, and I get it, this one's different, but still, I think it might be different in a more accelerated way. Typically, there's a pretty big rally in the bond market. Starts right around the time of that last hike. People don't wait. And we think the 10-year Treasury is going to 350 or lower by the end of the year, which seems like a big move today, but I think that's very attainable.
So that's great for equities?
Should be good for equities, but we have lots of equity gurus here today. I'll defer to you all. But as far as bonds go, we think that's a pretty substantial move.
So 3.5% in 10 years suggests a re-steepening of the yield curve, I would imagine. But there's this notion, and I've read a lot about it, it's the re-steepening when risk assets start to do their worst. Is that a concern at all?
It's really interesting, Guy. When you think about the slope of the curve, in the early days after the last Fed hike, everything seems to come down together in yield. So maybe the 2-year doesn't really quite keep pace with the 10-year, but it's pretty close. So I'd say for the next 3+ months, we don't really see a big reshaping of the curve. We think it's going to be more of almost a parallel shift for a while. So the curve shape, I think that's a topic probably 3, 4, 5 months out.
So let me ask you, the front end of the curve, though, I mean, how does this fit in at 5 and change still? Seems to be pretty sticky.
It is sticky.
A lot of issuance coming.
Yeah, a ton of issuance. I agree with that. And Treasury is really intent on even letting that T-bill number go higher as far as the percentage of outstanding and all that good stuff. But the front end is basically hostage to Jay Powell right now. So the next big data point for the front end, it's not PPI tomorrow. You can all sleep in. It doesn't matter. But wait for Powell at Jackson Hole in a couple weeks. That's the message people will care about. And I think that will drive the front end for quite some time. So we at Wells think it will be pretty sticky for a while.
What do you think happens with, what we've seen is some very tough labor negotiations, big union wins. I mean, I think the average driver at UPS will now make $170,000 a year. Good for them.
Pretty good.
Guy, you left too early, man.
Yeah.
I paved the way.
You are considered a hero in this house.
Thank you. I appreciate that.
But that just shows you how this could still be an inflationary force. Do you think the Fed has to be then harder than we may even think, given CPI, just because wages will be so sticky?
It's a really good point, Melissa. I suspect the Fed looks at that factor and nearshoring or onshoring or whatever and says these things all boost inflation. So that run rate is going to be higher than it was back in 2018 or 2019. Mm-hmm. So we have to be more vigilant and keep rates higher for longer than we did then. But the problem for Jay Powell is when he makes that point, people don't believe him. The bond market says, well, if you're done hiking, surely the next ease is going to be pretty soon, and you see a big bid for duration. So it's a really tough message for him to get out.